anyone could have bought any asset class and made money. Now is the time where actually the true operators that understand how to manage risk and how to structure deals and source deals and buy right. Those are the folks that are coming out of this and growing like us. People are experiencing capital calls or bad communication from other GPs. The less time that you have to go through and explain to somebody all the times you messed up, how complicated your structure is, and you really have to oversell to try to get a deal. To me, it's the first red flag that it's not a great deal if you need to financially engineer through different tiered waterfalls.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Ben, thanks for joining me.
Thanks, Joe. I'm happy to be here.
Yeah, we're looking forward to this call. We had a few minutes to catch up before this, so I'm looking forward to diving in. But before we do, it'd be great if you could just give the audience a quick overview of who you are, a quick intro.
Yeah, absolutely. So my name is Ben Schuster. I'm a partner at Comfort Capital. Comfort Capital is a manufactured housing investment firm based out of San Diego, which is a fancy way of saying that we syndicate capital and buy mobile home park deals. We're an operator, so we have 60 employees. We're vertically integrated. We do everything in-house. Been doing it for 16 years, family-owned business. We go deal by deal syndications. We just really love this asset class and understand it intimately. And so we only invest in this asset class. So I'm happy to kind of talk as much about the business as you like, but that's probably the 30,000 feet elevator pitch.
Yeah, thanks for telling me about the business. Why don't we dive in a little bit about you, because your background is interesting. I mean, you're coming to this from the institutional side. Give us the quick overview on Ben as well, not just Comfort.
Yeah, absolutely. So I have a pretty unique backstory. I was actually a youth homeless growing up. I had two parents who struggled with addiction. So most of my life was driven by housing instability and just instability in general. Was very blessed and fortunate to have a family that took me in to live with them when I was 12. So I lived with them from 12 all the way through high school, played a bunch of sports. I'm a big avid sports guy just in general, mostly playing versus just watching. And after high school, I went to undergrad. I studied finance and economics. I was just really interested in financial literacy, just in general. I did not grow up around people that talked about money, managing money. I kind of saw the opposite of that. And so that was my curiosity to dive into economics and finance. I did a dual bachelor's at Chico State, a small state school up in Northern California. After that, I worked my ass off and got into BlackRock. So got hired into BlackRock. That's a whole story in and of itself. I spent 7 years at BlackRock in San Francisco and Newport Beach. I started on a trading desk. I always wanted to get into private equity real estate. So then I moved horizontally onto the capital formation team for the private equity real estate platform, which is another fancy way of just saying I went out and raised institutional capital for private equity real estate that BlackRock did both on the equity and the debt side, which was really cool. I was a fly on the wall, as meeting with large pension funds, family offices, endowments, sovereign wealth funds. So you got to really understand how the 1,000-pound gorillas think about real estate, think about risk, and think about overall portfolio allocation. And then from there, I got really close with the portfolio managers and the CIO for the private equity real estate platform. And I ended up going and working for him. So I was an investor during my last couple of years at BlackRock. I was managing a portfolio of industrial, Class A apartment, retail, did some development as well. And I had one office in Houston. So I do have some experience in managing office assets. And then one day, my wife and I, this is during COVID, I'm from San Diego. We're sitting in San Diego. We just bought a rental property down here and we're sitting at a Starbucks. And this guy walks in, he starts talking about mobile home parks. I was fascinated, never met anyone that worked on the asset class, but I was very familiar with them. My mom lived in one. So I just always wondered who owned these things. And I was fascinated by just the fact that, the tenants own the homes and someone is actually owning the dirt and someone's paying a space rent. So I always knew that there were, great assets. And so on his way out, I stopped him. I was like, hey, overheard what you do. I'd love to buy you a coffee and pick your brain. That person was Blake Comfort, who is the principal and the founder of Comfort Capital, the firm that I'm a partner with now. And he's like, absolutely. I'd love to chat. He's like, what do you do? Told him what I was doing at BlackRock. He's like, man, I would love to pick your brain and see what you guys are doing. So we just became friends for about a year, just talking markets, talking deal flow. And then our dads passed away within the same year over the same thing, cardiac arrest. So we bonded over that. And then I think we just came to the same realization, like, hey, ever thought about leaving BlackRock and coming and joining us and helping us scale the business and grow it. And I love the entrepreneurial spirit of it. I love what they were building. I love the asset class. And so I did that in 2023. And since then, we've almost doubled our AUM. And this year, we're on track to acquire about $100 million worth of real estate, raising about $50 million of equity, all from, high net worth, friends and family, people we know, people that understand who we are and trust us. And so we don't do any advertisement or anything like that. And so it's been amazing. It's a
Yeah.
blessing. And so sorry, it's a little bit long winded, but it's
No,
tough to
it's
go through that story without giving all the details.
yeah, it's great. It's also like a testament to the value of curiosity too. It seems like you kind of like chase curiosity throughout your career. And then obviously the ultimate in terms of this story is, just hearing a guy in a coffee shop and saying like, I guess the value of curiosity and taking a minute from both of your sides, right?
Yeah, exactly. I'm not a shy person.
Yeah, fair enough. So obviously big transition from even if you were working on the real estate side, big transition going from BlackRock institutional, raising from pension funds theoretically and the like to talking to individual investors. Walk me through that transition for you.
Yeah, it's a huge transition. And I was actually catching up with a buddy that's still on the institutional side. And I was telling him about, hey, we're closing this deal, and told him the capital stack. And he's like, how many investors do you have in this deal? It's like about 75. Average check size about $250,000. He's like, oh my God, that sounds like a lot of work. But he's sitting there, through the entire year, hoping he gets that $150 million check, right? Or maybe it's the $100 million check. And he's got so many decision makers involved, whether they're consultants, investment committee, where I'm working directly with the decision maker, people that are managing their own checkbooks. And then they become friends, right? So it's someone that puts me in contact with a person, or maybe it's somebody I meet at an event, and they want to hear about the business, about you. And so you just kind of go down that path. They start talking about a deal after about a month or so. And then maybe they invest, but then I don't have a big sales team. I have a couple of guys that help me on the back end, but I'm the one that's speaking to everyone. Right. And so they become investors, but then they become dear friends. And so that's been probably the coolest part about that transition, is just being able to not only have, not only growing a business and buying really good deals and making money for people, but most importantly, like, becoming, some of these people are like mentors to me, right? Like our average investors, like 50, 60, 70 years old, they've probably sold a couple of businesses. They know real estate. So they become dear friends. They meet my wife, my kids, I know about their lives. So that's probably the coolest part about the job. Is just like that connectivity and those relationships that you build and that trust. So it means a lot to me. So when they write that check and the deals that we buy, when I tell them, hey, this is a good deal, it's because I truly believe it's a good deal. And I'd put my mom or my sister or my in-laws into these deals, right? It's because I believe in them. It's much more emotional than just taking an institutional check, where it's such a revolving door. So you might have a good relationship with a CIO at like a Cal Stirs or Cal Pers or Texas Teachers, but they might be leaving, right? And they might retire, or they might go to the next job in 5 or 6 years. It's so much more transactional on that side, where this side is so much more relationship based. So I really like it. Plus, I like the educational piece of it too. Like, I love educating investors about risk and returns and deal flow, and hey, don't put all your eggs in one basket, right? Like, what other things are you investing in? So I do feel like that piece of me, where it goes back to my story of like the financial literacy. Like, I've learned a lot through my years on just managing risk and understanding kind of like portfolio allocation. And so I try to instill that to my investors that want that advice, right? On like how they should think about retirement and how to manage their own portfolios, not just about investing with us, but anything that they do.
Right. No, that makes sense. I mean, I think the thing you're saying there that I think is so critical is just the value of those relationships. Obviously, you guys are 506B primarily, right? So most of your or all of your relationships are kind of closely held and have been with the firm, right? So that's like an interesting dynamic that I think people really struggle with as they make the transition to kind of a lead gen, more of a like lead gen mechanism. So 506C, Reg A, CF, whatever, however they're going to do it. And it's so important because it doesn't matter, because a firm needs to scale doesn't mean that relationship is any less important to the next investor that comes through the door, but you don't have it when they get there. Right. And
I
so,
agree.
so it's a very interesting thing. Tell me a little bit about this. So, Comfort Capital existed for a long time before you got there.
Yeah, 14 years before I got here. 13 or 14 years. So now we're on our 16th year.
So how was the transition? Obviously, there's the transition of you institutional to retail, but then there's also this transition of like theoretically they've been dealing with one of the investors, the LPs have been dealing with one of the comforts for 14 or 15 years. And
Yeah.
now there's the new guy on the street. Like, walk me through the process of establishing and transferring trust.
Yeah, no, it's a great question. So Blake, his primary role is sourcing the deals. He has all the relationships with all the brokers, obviously, our mortgage and mortgage bankers and everything like that for our debt. He's got all the reputation on the street and then with actually other property owners who were buying these from, mom and pops, and has a really good reputation. So he was doing that, managing the buying and the selling, and then the 1031 exchange. We do a 1031 exchange strategy after we sell our deals. We're kind of forever holders of the asset class because we just like to compound cash flow and net worth and avoid taxation and just defer taxation as long as possible. And he was raising the capital. So as you can imagine, it's like that is wearing both hats is a lot of work.
Mm-hmm.
And so when I came in, it was taking over the existing investor base, and people were, and they'll tell you now, they're kind of, I took over those relationships. And I think you have to be a pretty special person to be able to do that, where it's like, hey, no, I don't want to talk to you, Ben. I want to go talk to Blake, right? But I talk to all of our investors and they trust me. And it's because I think for a couple of reasons. One is I understand it very well. I'm in with the investment team, right? It's, Blake and Jen are brother and sister, the co-founders, the principals. And then we have another guy who leads all of our acquisitions and underwriting and everything like that. But it's really Blake, Jen, and myself who are the decision makers on a buy sell, right? And so because of that, I will never go raise capital on a deal that I didn't give the buy approval for or that I don't believe in. And so that transition went pretty smooth. I mean, it took a couple of years, and then I brought on all my own network of investors, right? So like the historical investors, I still talk to and love them dearly, but we have been adding more and more investors. And so our capital stack on our list on the names looks much different than the capital stack just 4 years ago. There's a couple of names that are still there, right? Obviously, but it's a whole new transition of individuals. And that's primarily just because, as you can imagine, people start to age out and there's only so much liquidity that a person has to allocate to an illiquid asset class.
Yeah, that makes sense. Well, without a doubt, we hear that as a challenge occasionally, especially if things aren't dispositioning or something like that. Because most of your investors either had a relationship with you or existed in the firm prior to you there, they kind of all know your track record, right? I mean, like at the end of the day, you're not dealing with having to talk about track record probably as frequently as most firms because they've experienced it.
Yeah, that is true. But I mean, on any given raise, 20 to 30% are all new investors. And so it's all repeat and referral. And the referral is the piece of the new, right? And so you talk about track record. We have a 16-year longstanding track record, never lost capital, never had a capital call. I won't go through our numbers, but they're good just because this is a public forum and we're a 506C.
Fair enough.
But yeah, you talk about track record, but track record is incredibly important, but people really at the end of the day sign the front of the check to people that they trust and people who are authentic and as well as they're experienced operators, right? Because the last cycle that we're coming out of now, I mean, anyone could have bought any asset class and made money. From 2012 to 2020, 2021, you could have bought anything and made money. Now is the time where actually the true operators, the true people that understand risk and how to manage risk and how to structure deals and source deals and buy right, those are the folks that are coming out of this and growing like us, having our largest year ever on record. And it's because of cycles, when the tide goes out, you start to see who doesn't have pants on. And we're going through one of those cycles right now. And so that's what people really look at. And so right now we're raising more capital and seeing the best deals we've ever seen because people are experiencing capital calls or bad communication from other, GPs where our entire portfolio is performing. We do 50%, fixed rate, loan to value deals. We don't financially engineer our things. We run a clean 80-20 split. We don't overcomplicate our structure. And so the less time that you have to go through and explain to somebody, all the times you messed up, how complicated your structure is. And, you really have to oversell to try to get a deal. It's kind of a red flag for most people where it's like, this just kind of sounds like too much and I just don't have the time for it. So it's like the keep it simple, stupid, really does go a long way. And we try to keep it simple.
Yeah, simplicity is really, really important in those, especially with just high net worths or credit investors. I mean, these are professional investors at the end of the day. Like you don't need to, they could get bogged down, which actually kind of leads to something else we talk about on this podcast a lot, which is over communication and under communication. So let's focus on communication just in general for a minute. I want to touch on over and under in a second. But first, in terms of kind of establishing the relationships with your investors, I want to focus here for a minute. Sounds like it went relatively smoothly. What I'm always interested in is like when things don't go exactly to plan, or like someone was used to some sort of communication and you weren't giving it that way, because you guys went through that transition. Like, talk to me about a time where, either at a firm level or at an individual level, you either inadvertently or things, inadvertently violated trust, or things didn't go quite as planned, and like how you think about navigating those situations.
Yeah, no, it's a great question. And communication is key. And I think you don't always want to over communicate as well. So maybe I'll touch on that after I hit the more direct question that you have. So like a time where things didn't go right. Like I think early on, going back to like Blake, both raising the capital as well as raising it, or, deploying the capital as well as raising it. Some of our earlier deals were more heavier value add in nature. So you could think about low occupancy. It's a big infill strategy because you infill the homes, or maybe you're buying a deal that sits on private utilities, whether it's private septic, knowing all those risks going in, but then maybe not having, because loans shifted at the last minute, not having the ability to ensure that you are budgeting correctly and raising enough capital to then execute on those deals effectively is kind of some of the stuff that we experienced during the 2019 and then going into 2020 on a couple of deals. One deal in particular, well aware of the risk. It had all septic sewers that were old, and they knew that going in. And then there was also it was 50% occupied, and there's a big infill strategy. So they raised all the capital. They came up a little bit short on the capital stack, but just kind of was like pushed through, ended up infilling those homes. And the thought was that you infill, you sell those homes, you replenish the reserve, you get a couple of years with these septics, and then you could then have the money to then budget to then change the septic to city sewer connection. So the infill strategy was going well. It takes a lot longer than anyone thinks to infill and sell homes in our space, which we experienced firsthand. But then 2020 came, where COVID came, and right at that time, those septics started to fail. And then you get pulled forward on having to address it and do the city sewer connections, which is a big multi-million-dollar project, which they knew going in. But the problem with COVID is that as they started these projects, the workers had to leave, material prices increased tremendously. Right. And then in order to get through that time, which was very stressful, they took another supplemental loan out. And then the GPs even loaned the property at no interest, no points, loaned some additional cash to the property to be able to execute. And then through that time, distributions got cut from 5 to 3.5. It was an early deal. So 1 year in, usually it starts at like 5%, cut to 3.5 for 6 months. But they did a great job communicating, both sending out emails and then calling all the investors. Luckily, at that time, it was a black swan event. So everyone kind of knew with COVID, like they understood, so everyone kind of got a pass during that time. And then they were able to get the property like 80%, 90% occupied. They got the city sewer conversion, and then we sold it to a $50 billion private equity shop that just got bought out by Apollo last year. We only did 11% return on that, but no investors lost their capital. Returns only, their cash flow only went down for 6 months from 5 to 3.5. And then we decided not to continue to hold it because we wanted to redeploy that capital into a better, more secure asset that we thought had better long-term value. So we don't always play to a track record. If there's money tied up into a deal and we have a better deal that we think has a higher net present value, which is just a mathematical way of just saying it has a better return, long-term return structure behind it, then we're going to sell that deal, even if it's only a 12%, 10% deal, and it's still early 1031 exchange, and then roll it into something where we think we're going to get a 15
Got it.
plus with more
Understood.
certainty. So those are just, we're kind of operate more almost like a family office rather than just kind of like this deal churning machine that like plays to a track record, because we're always struggling to raise capital for our next deal. We don't struggle to raise capital because we're not buying deals that we believe is going to be hard to raise capital for.
Got it. That makes sense. Okay, so what I heard in that story was obviously like the problem that you ultimately encountered was already underwritten, but it was underwritten further to the future. Couldn't underwrite COVID, so
Correct.
that happened. Steps the GP took was communicate early, didn't stop distributions, just cut them. Loaned the fund or the deal, that was not a fund, loaned the deal money at no point, so at their own expense, and then dispositioned the deal at a gain for the investors. Along the way there, like, was there anyone coming back being like, hey, this is unacceptable? Or do you feel like the communication, you weren't there, right? So the communication strategy.
I wasn't there. No.
You
So that
weren't
was
there,
right
right?
before my
I won't
time.
get too much into this. This is a good story. Thank you. That's perfect. It's like, I
Yeah.
think, as we talked about before the show, like, I think LPs that are listening to this are, one of the things we try to get a sense for is like, how do you react when something goes wrong? And like,
and you always like, I mean, the question there is like, and so I've been fortunate that, and knock on wood, it's only been 2.5 years. So we'll follow up in 5 years and maybe I'll have a story. But like the way you always address this, right, is like, you got to be upfront with communication. You always have to communicate that what the solution that you're working towards, right? Being clear, because people look for leaders and they want to look that people not only address an issue and they don't blame somebody else, they take responsibility, but they have a clear line of action on how to resolve it, right? And they lay out exactly how they're going to do that. So that's the way you always communicate to any sort of investors, especially when you have the responsibility of managing capital, which I think is the most important thing. I mean, money is a very sensitive topic. It's like religion, family, and then money, right? So it is a very, it's a very important job. And so you need to make sure you do a really good job at communicating and instilling trust to people and keeping trust. It's hard to get trust. It's really easy to lose it. Otherwise, you're going to have a short career in private equity real estate, right?
Yeah, I think without a doubt, it's really hard to scale if you can't get investors. I think that, part of the dynamic that we're facing in the market, we're seeing it obviously in the reviews, right? Like, not only did people not have some people maybe have like I don't want to like judge what people actually did, but like it appears that some people didn't underwrite their deals properly, maybe pursued financial strategies that were a little overextended, some investors are paying the price. I think the problem and what we see from LPs is not even like they know they're taking a risk. LPs in general, right? If they've been communicated to properly, know they're taking a risk. They get really upset when the person who they trusted is not honest with them or just is not present. Like that seems to be the underlying theme. Like LPs can tolerate some amount of market volatility or things not going exactly the way they planned. They know that they took a pie in the sky deal. Like sometimes that doesn't go exactly right. But when the person they trusted doesn't take ownership of that and communicate with them, that's when they really get upset.
I agree completely with what you're saying. And even just like, another like just thing, because I don't have a huge sales team and I'll get clients that call me every once in a while, and who knows, maybe it's someone that, the mom or dad, died and the kids has it now. And he's like, what is this that I got, that I inherited? Doesn't understand it. So he's calling me asking to redeem or whatever. And so I'll work through him to try to find someone that will buy those shares. And so sometimes you don't always know like who you're dealing with. And so what I always try to do is like understand it from their side. Not every investor is the easiest to work with.
Right.
And because I don't have a huge sales team and I have young kids and I have a life as well and helping grow and run a business. So what I always try to do, if someone calls me, I don't get back to them right away. Like I'll make sure that like, hey, I'll send them a quick text or an email. Hey, I'm really busy. I promise I'll get back to you. And I always make sure to follow up with them, whether or not they're happy. If it was a couple of days or a week, everyone has their own kind of perception of what's urgent and how fast you need to get back to somebody. But stuff like that happens all the time. And so I just always try to over communicate. People have my cell phone number. All my investors have my cell phone number, so it's like, you just call me, you get in touch with me, and I'm pretty responsive. I'm a little bit of a workaholic. And so I'm trying to change that, but it's not hard to get a hold of a senior person at Comfort. And
Yeah,
so which is nice.
that's good. Well, I mean, important for maintaining those relationships with investors. But we should I'm interested in the recap that we do 2 or 3 years from now that you just suggested. It'd be
Yeah.
interesting to see how it scales too, because I think one of the things that we note, and we wrote an insight article on this on Invest Clearly Insights about the communication pre-investment to post-investment communication gap specifically starts to like really show up in the reviews as firms scale, especially like over $1 billion. You start to like AUM, we really
Yep.
start to see it because the teams are bigger. So it's just like, it'd be interesting for you to get your perspective as a leader, as your team builds out,
Yeah.
on how you maintain
We're
that.
the Dean Garazio, who's just an interesting guy. We like subscribe to Tony Robbins, and he's kind of part of that network. But I read one of his books, and he talks about how no one focuses on the post-sale transaction. And so that's something that we really are trying to emphasize. We do quarterly reports. We have big investor events every year where we bring everyone out. And so we do fun stuff. We really actually enjoy our investors. So as much as like I'm pitching to someone to convince them, there's times where I'm allowing them to do the same to me, because I don't want to take on a problem. I want to work with people that actually will improve my life,
sure.
and I enjoy speaking with. But he talks about that post-sale transaction. And so we think about that a lot. So we do really cool, like today's closing day for us on a $28 million portfolio that we're acquiring.
Wow.
So I'm just waiting for the text on title recording, but money's been issued from escrow. So we're like going through our entire list, and I know everyone personally, and I know like, oh, I know this guy loves Ferraris and he has a 296. So I'm going to get him a model 296 Ferrari, like, and I know he likes, he or she likes really like nice wine, or I know they like these restaurants. So like personalize those gifts out to them. Right. And so trying to do stuff like that, because that's what's cool about being a young entrepreneurial firm. We're all in our mid 30s, young 40s with kids and trying to grow a business. It's like, we want to do things different. That's why we office out of a hangar, like in San Diego. We are all like the aviation background. So it's like, we just want to do things that give people a sense of like, this is cool. These are great returns, but I actually like this experience, and it's fun, and it's different than just investing with somebody else. So we're trying to, not only are we trying to change the stigma of mobile home parks, right? Like manufactured housing communities, really elevating the living standards and bring the standard up so we could, a rising tide lifts all boats. That's why we invest millions of dollars back into the communities. But the same thing with the investors. Like, we just want it to be a really fun, cool experience. That way we could all have fun and make money together and enjoy our lives.
That's great. I think that's a good place to start wrapping it up. But before we do that, we ask everybody this question, LPGB. You probably heard it since you listen to LP podcast. Pat would say, what part of passive investing needs to die? Like, what element of this whole ecosystem is just no good, needs to go?
Oh my gosh, that's so funny you asked me this question. I was thinking about this last night. I was reviewing a couple of deals that people sent me to invest in personally. And I think all the tiered different asset or share classes to invest in, that needs to die. The complexity on the investment structure, to me, I hate it. And I'm a very sophisticated investor. I understand waterfalls, but I just looked at someone's deal and it was like Class A shares, Class B shares, Class C shares. It's like, for a $30 million or $20 million deal, it's like, what are you doing? Why do you have so many shares? And one of them was cash flow only. Like, if anyone's listening to this, you should never invest in equity if it's cash flow only. Like, just go on the debt side and get in a more senior position than to get a cash flow only position. So I think that people that overcomplicate waterfalls and tiered structures, I just think it's ridiculous. And to me, it's the first red flag that it's not a great deal if you need to financially engineer through different tiered waterfalls. I'm not talking about co-GP. If you invest $5 million and you get a piece of the GP and you get a little preferential treatment, I'm not talking about that. I'm just talking about all these different share classes that people try to do and all the complexity. It's like, just keep it simple. So that's what I think needs to die in the syndication and passive investing realm, is all just the tiered waterfalls. It's too complicated and investors just don't understand it. And I don't even understand. I've been doing this for a long time.
I think it's a good word. All right. Well, if someone listening to this podcast wants to find you, wants to find Comfort Capital, where should they go?
Yeah, you can find me on LinkedIn. I'm active on LinkedIn, Benjamin Schuster, or you could find us at comfortcapital.com. There's a button there to submit your information if you want to learn more. You can't see deal flow unless you kind of go through me and we build a relationship, but I'm an easy guy to talk to and I love meeting new people. So feel free to reach out.
Thanks, man. Really appreciate your time.
Thanks, Joe. Have a good one.
You too.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review because that's how other people find the show. Till next time, invest clearly.